Our last component in the positive test in terms of the general deduction formula is the one that is not of a capital nature. And you'll see that, I mean, this echoes what we had in gross income, right? So for gross income, we also exclude amounts that are of a capital nature, and the same for general deductions. We're not allowed to claim an expense if it is capital in nature. Be very, very careful. Do not use court case principles of gross income, like FISIT, for example, when you have to discuss whether or not an amount is capital in nature from a general deductions perspective. We've got 3 court cases here, and those are the ones that we'll use to determine whether or not an amount is not of a capital nature from a general deduction perspective. There are a number of tests that have been laid down by the courts that we can use to determine whether or not an expense is capital or revenue in nature. And of course, if it's capital, it's not deductible. If it's revenue in nature, then we will be able, provided that it meets all the other requirements, we will be able to claim a deduction for it in terms of the general deduction formula. We have the operations versus structure test. In other words, we are asking, is the taxpayer incurring costs to perform income earning operations? That will be revenue in nature. Or is the taxpayer incurring costs to establish or improve income earning assets? So, for example, if you buy a factory building as a manufacturer, that is the cost of establishing a capital asset, so it's capital in nature. But if I have to pay water and electricity every month to keep that factory running, that is going to be the cost of performing my income earning operations, and that will be revenue in nature. We also have the true nature of the transaction, and this one links back to what is the purpose of the expense. The closeness of the connection to the income earning operations, and this one is very close to the first test, that operations versus structure. So is the money spent on working the income earning assets, which means it's revenue in nature, or is the money spent on creating, improving, or acquiring income earning assets, because that is capital in nature and won't be deductible. Do we have an asset or advantage for our enduring benefit? So, enduring benefit can sometimes be difficult because, what is exactly is the timeline associated with it. But if you think about things like recurrent expenditure, like rental payments, water and electricity, audit fees, etc., those are generally not for enduring benefits. They are recurring, so they are usually deductible. So if an expense creates an enduring benefit, like, a computer, if you buy a computer for your business, you're going to be able to use that for at least 2-3 years. That is enduring benefit, and therefore that computer will be capital in nature, not the cost of that computer will be capital in nature, not deductible. Another test we can use is the one of fixed or floating capital. So capital that is not consumed, not used up in the process of income production is known as fixed capital, and it's capital in nature, so not deductible. Or if you think about something like trading stock is an asset, but it gets consumed in producing income. You either sell it or you use it in your manufacturing process, etc., which means it's floating capital and therefore revenue in nature. Another test we can use is once and for all. So once and for all, it's not recurrent. It's you buy a computer today and you're going to be using it for 3 years. You're not going to buy it today and you're going to buy another one tomorrow. It's like not like coffee and tea that you buy for your staff to drink. You buy a tin of coffee this week and you're going to have to buy another one next week because it's finished. Then, the nature of the business, this one is quite important. Because for some people, a computer is going to be a capital asset. Like if I have a hair salon, for example, and I buy a computer to do my admin, that is going to be capital in nature because it creates enduring benefit. But if I am a computer business, my business is the buying and selling of computers, then that computer is not going to be capital in nature. Then because I use it as trading stock, I don't create enduring benefit, it's floating capital, and therefore the cost will be deductible. So please make sure that when you consider whether an expense is capital or revenue in nature. Pay specific attention to the nature of the business that the taxpayer carries on. And then there's also one halfway house between capital and income. And the idea here is just that, one amount can't be both income and capital in nature at the same time. So you can't have an expense, a computer, and say, well, it creates enduring benefit, but I'm also going to be using it as trading stock. It doesn't work that way. And because we can't have one amount be both capital and revenue nature, if it needs to be, it has to be apportioned. But at this point in time, this hasn't yet been tested by the courts. Usually for capital expenses, it's very clear. It is either capital in nature or it is not. Now, the court cases associated with capital in nature, there's 3 new state areas, BPSA and Rand mines. So new state areas, if you look at the duck there, or the goose that laid the golden egg, and this one is similar to our first test as well. We have to distinguish between the cost of performing income earning operations or the cost of establishing or improving income earning assets. So if we are incurring costs to perform our operations, they will be non-capital in nature and deductible, and these are things like water and electricity, rental payments, etc., etc. The cost of establishing or improving income earning assets, that of course is capital in nature and not deductible. BPSA said where we incur expenditure but no new capital asset for the enduring benefit of the taxpayer has been created, the expenditure tends to assume more of a revenue character, and if it's got a revenue character, that means, of course, that it will be deductible, provided that it meets the rest of the Section 11A and 23G requirements. And our last court case for not of a capital nature is Rand mines, and you'll see again it links very closely to new state areas, because the principle in this case, or the principle, in this case was expenditure will be capital in nature if it's cost that is spent to acquire or create an income earning structure, right? So this one links closely to that test. And we need to distinguish this from expenditure incurred to work the income earning structure, because that is going to be revenue in nature.